Hey everyone, this is Robert Keens with goldsilverpros.com. It is Monday, December 14th, 2020. And I wanted to do an article today on silver because I've been going back over the year 2020 and studying the precious metals, and something really stuck out to me with regard to the availability of silver when we first had the shutdown starting back in March, and how the precious metals markets reacted. For that reason, I want to talk about silver, and also for another reason. I basically got into an argument with somebody on Twitter, not looking to get into an argument, but somebody was challenging my assertion that there may have been shortages in the metals earlier this year because the depository statistics for the physical metals stored at COMEX were healthy. And this person, I think, was using non-logical, non-linear arguments. And they're a fairly popular person that actually works in the gold and silver industry. They work at a depository or a physical storage location. And I think their objective was try to debunk what I had been saying. And they had come out on one of my friend's shows, very popular show, and I think we're potentially spreading misinformation. I don't want to name this individual because I'm not interested in doing that here. I just wanted to look at the arguments and use data to look at the arguments. And I think I have effectively counteracted that argument in silver based upon some additional data I looked at in a report that came out from the Silver Institute that was covering the gold and silver trade during that time frame. So let's get right into the data here. I'm going to share my screen. I'm going to start off by going to Nick Laird's site. This is a pay site. I'm not affiliated in any way with Nick Laird at Gold Charts R Us, but if you want time data on the COMEX and on the other markets, the Shanghai, the Japanese market, the London market, this is the best place to get it. Specifically for the COMEX, a lot of their physical delivery data, they only leave up for a day. Well, they leave the depository statistics up for a day, and the physical delivery data in detail up for 5 days. And then of course you get an annual report, but they get less and less information as you go along. So if you want to build like a time series or look historically at anything on the COMEX, this is the best site to do it. And that's why I recommend it. It is a pay site, definitely worth the money if you guys are interested. I wanted to talk about why the COMEX may have been short of silver when the panic hit and the shutdowns occurred and people started flooding to the precious metals, even back in as early as March, but especially over the summer. And then we eventually saw that price spike. If you look at the actual silver open interest, this is the open interest leading up to 2020. Been really high, and the start of 2020, it has started to fall down. But the deliveries overall have been very strong. You can see contract deliveries spiked here right in the middle of 2020 when we were looking at the shutdowns and the panic. And the delivery contracts as a percentage of the overall open interest had spiked as well. So more deliveries when measured against the open futures positions. And that's significant because typically in the COMEX, it's a futures market. It's a paper market. By and large, it's dominated by paper market. In London, it's really the OTC market, over the counter, where you do more physical delivery. And then Shanghai has a mix of physical delivery and futures. But COMEX is really more of a paper market, a futures market, than it is physical delivery. Everybody pretty much agrees on that. But you saw with the panic, people were flocking to silver. Okay, first of all, I wanted to point out that silver is still a monetary metal. When people panic, they don't go just to gold. They go into silver just as well. Silver's been money dating back about 6,000 years. I have an infographic on my site that talks about that. Maybe I'll repost that again someday, but you can go to my site and see it. So silver is still basically money, or a safe haven asset. And you can see that clearly in the data. As we get further into this, I want you to remember these charts I'm showing you on the website, because it gets really interesting. The next one I'm going to show you is the COMEX holdings of silver. And you can see this is 2020 right here, this little line right here. And you can see that there's a lot of both registered and eligible. I'm going to go back over really quickly what registered and eligible are, because I know a lot of people are new to my channel. We're constantly getting new people and asking me to explain this. And I've gotten a lot of emails recently asking me to explain this. So I'm going to go over it again. If you're a veteran, we'll go over this here pretty quickly. There are two main types of gold storage on the COMEX. There's a third that we don't talk about because it's not basically utilized nearly as much. And so I tend to leave it out as a percentage of overall physical storage. So we're going to talk mostly about eligible and registered. Eligible, contrary to its name, is actually not eligible for delivery on the COMEX. The CME group has admitted this in a memo they released earlier in April this year. I went over that in a video a month or so ago, and I'll try to put the link. If I forget in the comments, you guys let me know that I forgot to put the link to the CME group memo, and then I'll put it. where they admitted that they couldn't tell how much of this eligible, which is this light green here, was actually deliverable on COMEX because it's actually private stored gold or silver. And there's no warrant attached to it for futures delivery. It's actually privately titled. And they don't know how much is going to move from eligible into the registered category, which is the actual deliverable gold or silver at any given time. They admit this. And the reason they admit it is because that they don't know it's privately held. And it would take a certain price to pry that gold and silver from the hands of people who own it and just happen to hold it in a COMEX approved depository. So for purposes of delivery, you can pretty much scrub out this eligible for most part, although the COMEX and the CME group, which manages the COMEX in the past, have claimed that this eligible is liquid. They've admitted that it's not as liquid. So we know that at least a high percentage of this is probably not going to come out unless you get a high enough price, and you basically can go, grab that gold or silver from someone. You just have to offer a high enough price to get it. But all this light green is not really going to delivery. The registered is what could go to delivery, but doesn't necessarily need to. It's where so all this registered doesn't get delivered every month or trade hands every month physically. No, it could, but it doesn't have to. But you have to be in the registered category to be eligible for delivery. This light green is not eligible. And as you can see over time, the majority of the silver in the market has gone to eligible, where it's just stored in private hands and doesn't come out for delivery on contracts. Same thing with gold. The difference between silver and gold is gold had been razor thin up until about April or so of this year. And then there was a flood of gold from London. We've shown the delivery statistics from London proving that most of the gold that came into the COMEX starting in April this year came from London. And in silver, however, supposedly the COMEX is reporting a healthy amount of liquid gold in the registered category. Now keep that in mind as we get further into this data, that in silver, it was different than gold. A bigger proportion of total physical silver stock at the COMEX depositories was registered, meaning we suppose, according to what COMEX says, it is liquid and ready to be delivered should it be requested by a long position on a futures market. Keep that in mind. Now we're going to get into information having to do with the OTC markets and physical delivery. The LBMA is an OTC market, physical delivery market, and they have provided data as to how much physical gold and silver has changed hands or been delivered on their market. I'm actually going to get to that a little bit later, but keep in mind that this data is on the website, and actually put this onto a spreadsheet for you guys so we can show a trend. Because when you look at a data table like this, if you're visually oriented like me, it's harder to see trends. Well, I've got a trend graph for you. We'll get to that here in a moment. Okay, so going back to COMEX, supposedly healthy supply. So if somebody wanted to stand for delivery, it was there. But something interesting came out in a report from the Silver Institute, which I'll get here in a moment, for exchange for physical. What is exchange for physical? Exchange for physical is different than physical delivery and COMEX. If you're on the COMEX and you stand for delivery, you're taking a long futures contract, and that short has pledged to deliver those physical ounces to you. That's not an exchange for futures. An exchange for futures is when you're taking the difference between the prices in the spot delivery market in London and the futures market in COMEX, and you're arbitraging that. Banks like to do that to effectively offset their exposure to the metals. The exchange for futures can also be used for futures delivery. According to Investopedia, we're going to talk about exchange for physical here. An exchange of futures for physical, we'll just call it EFP from now on for short, is a private agreement between two parties to trade a futures position for the basket of underlying actuals. An actual is the actual physical commodity, in this case, silver. An exchange for futures for physical or EFP can be used to open a futures position, close a futures, or switch a futures for an underlying asset. The key thing is the third data point down here. EFPs are especially useful when a large transaction takes place, so the market price is not artificially altered by non-speculative trade. Exchange or EFPs is one of the few types of privately negotiated agreements that can be registered with the exchange. The volume involved in the transaction is shown the day's trading, and the transaction was completed privately agreed upon. So in other words, we don't know what the prices were in those EFPs. The price is not printed like it is in the rest of the futures market data. So if you're exchanging the future contract for the physical position in the other market, the OTC market in the London market, that pricing is not reported. And we'll see why here in a moment. Under advantages of EFPs, The obvious question is, why not just do the transaction through the market? In other words, just settle through COMEX. Why not do that? The answer is simply for the sake of efficiency. Large transactions impact the market as they're executed. In other words, if you do a lot of delivery against COMEX, it's going to spike the price. And I've said this over and over again, and this is confirmation of that. This is why large traders sometimes break up transactions over time, or they can do the EFP outside the market pricing mechanism because they don't report the market price. It can't change the market price. Aha, that's one of the reasons why you do an EFP. You're taking a large position and you're wanting not to affect the price. Well, there's another reason. Listen to this last sentence in this paragraph. EFP is also used when the market depth is not able to absorb the transaction. For example, a transaction involving thousands of contracts. So either they don't want to spike the price so that they can do this large transaction and which won't affect the actual market price, or the market depth of the actual physical commodity is not there in that market. So they use an EFP to get it on another market, thereby indicating that if EFPs are spiking at this time when the COMEX says they have a lot of silver, either they're not wanting to spike the price of silver, or the silver is not actually there. So they don't settle on the COMEX, they do an EFP to take the physical delivery. There's another reason why you'd see EFPs escalate, and I'll show you that here in a moment. I wanted to give you some information on CME Group further about what EFPs are. I'm going to continue to define an EFP so it makes sense because I haven't covered this a lot. Who trades EFP? Who are the suspects, in other words? Banks prefer to be short exchange of futures for physical, meaning short the futures contract and long the physical as they get closer to the futures expiration. Why? Because we've shown time and time again, the bullion banks are the massively short position on the precious metals. Rather than having to square their OTC exposure systematically across wider spreads and less liquidity, EFP allows traders to hedge the gold markets more efficiently, meaning they can come to COMEX and use the futures market to do paper shorts, and they can be long the spot market in London. They typically run OTC positions with an offsetting futures position to be price risk neutral and to use EFP to manage basis risk. So they use the EFP to manage the risk. They can go long and short in different markets and manage that risk. And they use it for arbitrage while authorized participants can redeem ETFs. Authorized participant is an ETF like GLD or SLD. So the banks usually do it to offset their short position on the COMEX. They take a position on the London OTC. And when they're massively short and there is a market panic, the longs come in for delivery and all of a sudden they've got massive shorts on COMEX. How do they break that up? We'll get that to here in a moment. We've got one other thing from the CME Group who manages the COMEX explaining what EFP is. Loco London spot against COMEX gold futures. Two markets, London, COMEX. London physical delivery, COMEX futures. Okay, London physical delivery, COMEX futures. The Loco London T+2 spot gold silver versus COMEX, known as EFP. Arbitrage means that the hedge OTC positions long or short are in a transparent, liquid, and cost-efficient environment. Typically, the OTC leg will be rolled on a tomorrow next day basis, so on, so forth. The new spot spread products launched on COMEX offer spontaneous hedging to the spread risk between futures and OTC position market participant. In other words, if you've got an OTC position and a futures position, you use the EFP to arbitrage that, or potentially take delivery if you want to. Okay, so all of that makes sense. Exchange for physical is a way to arbitrage the difference between futures and physical using the two different markets, or maybe take delivery of the physical, especially when the market depth doesn't exist. Now, the COMEX is saying the market depth did exist in 2020 when we had the panic, according to the registered stocks. Remember, I'm not even counting eligible. I'm not counting this vast hoard of silver that could be available in the depository should the price be right, and the private owners who have that want to give it up by moving it to registered. I'm just talking about the registered, which is the actual eligible for delivery against a futures contract. So if you had a lot of actual effective deliverable silver in these COMEX depositories in this registered category, you wouldn't think that you would see a lot of EFP. But going to this publication, the 2020 release Silver Institute Interim Silver Market Review, we're going to see the exact opposite happen when the panic occurred. So the panic occurs and there's a lot of delivery. Now we're going to go to the OC market data to show you that delivery information. Remember, I told you earlier that I have the clearing statistics on the OTC market, or the biggest physical delivery market in the world, This is the biggest physical delivery market in the world. I've taken this and graphed out just the silver piece of it, and we're going to show you that on a spreadsheet. So on the spreadsheet, and I'm going backwards, we're going January from the right, reading to the left to October. So this is January 2020, October 2020. We see when the panic hit in the Western markets, almost 450 million ounces of silver were delivered in the physical delivery markets on the OTC, 431 million ounces, for a total market value of $6.4 billion of silver in March when the panic first hit. The people in COMEX see this and they panicked. Who would panic on COMEX? Who has to deliver the metal? The shorts. Who are the shorts? The bullion banks. The bullion banks see the spot market deliveries blow up as a result of the panic in March, and they freak out and they say, oh my goodness, longs are going to come to deliver on the COMEX. So that's when you do exchange for physical, because to exchange for physical, you then take a long position on the COMEX to offset that risk. Here's what happened according to the Silver Institute, exchange for physical in March. It spiked. Why? Because all these bullion banks are short the silver market and they don't want to have to deliver. So they use EFP to get the long exposure. Notice the report from Metals Focus, who did this report. According to sourcing data from Bloomberg and the Morgan Stanley EFP index, a jump in silver EFP in spite of COMEX stocks being at record high levels. If the bullion banks thought that they had all of this liquid silver back here that they could deliver in this coming onslaught, remember, we know the onslaught is coming to COMEX because on the actual biggest physical delivery market in the world in London, it spiked to almost 450 million ounces in March. So they see that data in London. They know it's coming across the pond to the COMEX, and they have all of these ounces, hundreds of millions of available ounces in silver, and yet the silver EFP spikes, and it stays spiked all the way through the end of July. Why would the silver EFP spike if you had all of this available ounces for delivery on COMEX? Because they didn't want to deliver it even if they had it. Why? Because the damn price is too low. Either that, or remember, they don't have the market depth. Remember the explanation from Investopedia. EFP is also used when the market depth is not able to absorb the transaction. For example, a transaction involving thousands of contracts. Maybe the market depth, they didn't actually have what they said they had, and they saw this data from the London market and it freaked them out. What else happened at about that time? A couple months later, we documented what? In a video on July 14, 2020, you can see down here highlighting on my channel, YouTube, July 14, 2020, I'm showing a report from July 13th, the Metal Depository Statistics from CME Group, the silver stocks. This is silver, troy ounces, 7/13/2020. I'm going to fast forward here and show you what I highlighted on that report on July 14th. JP Morgan Chase Bank, who runs a depository, who has the most physical silver at the time on the depository, had almost all of its 160 million ounces. You can see right here, 160 million ounces ineligible, not for delivery. But we saw them move almost 39 million ounces up to registered for delivery. Remember, registered right here, this dark green is for delivery. You see this spike from here to here? This is the JP Morgan spike. Why, if all of this registered existed, would JP Morgan have to move almost 40 million ounces to registered in a single day from eligible if the market was that liquid? Remember, we saw in March people flooding to silver as a safe haven asset. We saw it in the OTC, the physical delivery market in London. Remember this data, to the tune of almost $6.4 billion at a suppressed silver price. I think it was trading like 14, 15 bucks an ounce at that time. We saw the massive deliveries coming. This would predict the price spike we started to see in July, which I talked about on my channel. And on this video, see, I said silver futures activity predicting explosion, because JP Morgan was moving a massive amount from eligible to registered. Why would they have to? If all of this was liquid for delivery, why would JP Morgan have to? And why would the EFP market spike in silver for months on end if all of that was eligible for delivery? I know that the bullion banks want to offset their exposure And they probably couldn't on COMEX offset all of their shorts on COMEX and by taking longs on COMEX. So you have to use the EFP. But also the EFP can be used for promising physical delivery, for basically saying, okay, we're going to match. Okay. What they do is it's a private market. Think about it this way. The OTC is a private market. Let's say all of this silver was not deliverable. The market sees the spike coming here in London. It knows the spike's going to come to COMEX. This is actually all not liquid. And the banks know, because of their massive shorts, the bullion banks know they're going to have to deliver a lot. That's when you use the EFPs. Regardless if they're price arbitraging or they're having to privately guarantee physical delivery in the London market, one or the other, this spike here, in spite of COMEX stocks being at record high levels, what they're referring to is this: they had to use EFPs. That's different than gold. The reason the gold EFP spiked is because on the gold stockpile report, most of it's not liquid and registered. In silver, there's a lot liquid, and yet it spikes, the EFP spike in spite of COMEX stock being at record levels. I also want to point out for gold, by the way, EFP spikes because I don't think all the gold eligible was actually liquid either. Now we know the register stocks were down, but I think I have questions about all these numbers because of the way the market is reacting. Would JP Morgan have to spike up 39 million ounces into registered if all of this was already here? Look at this healthy amount of liquid deliverable and this potentially liquid deliverable at all-time levels in 2020. All-time levels, according to the Silver Market Institute. All-time record high levels. That tells me it wasn't liquid. That tells me these numbers aren't necessarily correct. So resolution to this. What does all of this mean? It means that gentleman was arguing with me about the liquidity of gold and silver on COMEX in April, when you saw this massive monetary demand come in for delivery. Maybe it wasn't as liquid as the depositors would want you to believe. After all, this gentleman worked for a depositor. Was he trying to deflect from the potential liquidity issues? We know in gold in April, London transported a lot of gold over to the COMEX. That's historically not what happens in gold. And JP Morgan bailed him out with 40 million ounces in July, early July. The silver end of it, the silver market. If you had all of this available, both registered and potentially a lot ineligible deliverable gold and silver, specifically with silver, it doesn't make sense. You had that massive amount of registered, which should have been able to handle and cover for a lot of the bullion bank short position, and yet they flocked to the EFP, the exchange for physical, to arbitrage between COMEX, where supposedly there was a lot for delivery, against the London OTC delivery market. And I don't think it was just a price hedge. Remember, it's a private transaction in which it doesn't move the market price. It doesn't alarm people that silver's spiking. And you can also pledge that physical delivery in London against a COMEX position if you want. The actual, remember, Investopedia, the actual commodity for the futures position. I don't think it was just price arbitrage. Why would you price arbitrage the two markets when you had all that physical silver? Why wouldn't you just deliver it? If physical silver is priced appropriately, just deliver the damn silver. You know it's coming. We saw the data in the London OTC market in March. You know they're going to come in the US. And if you believe the silver's price is legit and the market is setting it correctly in the futures market, just deliver the silver. But they either didn't have it or they didn't want to let it go at that price. Remember the Investopedia article. It's either that they're settling for a private price, or it doesn't have the market depth. They didn't have the actual physical commodity for delivery. One or the other, or both. So it's possible that silver was undervalued and the bullion banks got caught with their pants down, and they don't want to give up all that physical silver. Mostly JP Morgan Depository, which held most of it. And or probably also they don't actually have the liquid silver that they said they had at the time. That's what that data tells me. There's one other interesting thing, that I want to share with you on that report. We're going to go down here. Oh, also the COMEX depositories, also as reported by Metals Focus all year, were healthy. This is January of 20. Look at all that metal on COMEX. If all this was really liquid, why the EFPs? Why the EFPs? Explain that to me. Why are they panicking in spite of COMEX stocks being at record levels? Doesn't make sense. One other thing I want to show you guys, not directly related to that. I want to show you where I'm really bullish on silver based on investment demand. This is a global demand summary for silver as reported by the Silver Institute, Sources Metal Focus. Now, overall silver demand is down, and you can see the red categories where it's down: jewelry and silver, industrial and photography. The one thing I want you to pay attention to here, physical investment, that's bars and coins, has made up for almost identically to the industrial and photography. This is 44.9. No, I'm sorry, 48.9. If you add these two numbers together, it's 49.8. So the physical investment increase in 2020 for silver is higher than the drop due to the deflation in the economy of the industrial demand for the first time in like forever. And remember, the marginal demand in silver is the investment demand. When people get scared and they go into gold and silver, that investment demand is what spikes the price. And we saw that. The physical, I'm telling you guys, the investment demand for silver is really high right now. The only reason silver price has not spiked back up in that $40 range, $35, $40 range, is because of worldwide deflation. The industrial demand has fallen almost equal to the increase in investment demand. But that investment demand is so high that tells you that people are bullish on silver as an investment. And remember, most silver above ground is used up. It's in electronics in little baby amounts or medical devices or whatever, and it gets put into landfills. So when you have this spike up in investment demand in silver, it cannot be absorbed by all the silver ever mined like gold can. It can only be absorbed by available above ground stocks of silver. So going into 2021, remember the articles I did all last week, the potential crash in the real estate market, the potential crash in the stock markets, you looking at all the data, looking at all the evictions and foreclosures, and I saw a piece of data today on Zero Hedge. The National Restaurant Association is reporting 110,000 closed restaurants in 2020 will never come back, permanently closed, not temporarily. 110,000 according to National Restaurant Industry, 110,000 closed this year that are reporting they will never come back. They close shop, they're done. Look at all the people that are unemployed. Look at all the dislocation in the economy. That dislocation is going to lead to a collapse in the markets. The deflation in the economy is going to lead to a collapse in the stock market, the bond market, the real estate market. I think it'll start in real estate. I think they'll start to propagate out to the banks and the bond market, and then it's going to hit the stock market. I think that's the way it's going to go. That's going to start for earnest in 2021. Okay, the shutdowns in the economy are what caused that. The shutdowns in the economy are what caused that. They caused people to flock to gold and silver, and you saw that spike to all-time highs in gold and really good numbers in silver. And you're going to see a bigger spike in 2021. This number of physical investment is going to go nuts, and that's where you're going to see the silver price spike up. Why? Because data suggests that all here on the COMEX doesn't actually exist. Because why? Because the exchange for physicals. This is another canary in the coal mine. Why did this spike up if the bullion banks had it to deliver? One, to keep the price down because you do a private transaction. That's what an EFP is. Remember this here. Because they don't want to change the actual market price. It's right here in this paragraph on Investopedia. And also because the market depth of the actual physical is not there. Think about it, guys. Think about, now do you believe the inventory numbers? Now do you believe what COMEX tells you? The more I look at this market, the more I don't believe the numbers, and the more I believe that the investment demand for silver is very strong, can continue to get stronger, and is going to lead to a really healthy silver market 2021, 2022, 2023. I think it's going to last for several years. I don't know if we're going to get $50 silver in 2021, but I think it's going to go that direction. And remember last week, I also talked to you about technical charting in both silver and gold, bullish formations forming in silver and gold. Technically, fundamentally to the economy, and fundamentally to the actual physical silver available, I think are all telling us silver is going to be in a bull market in 2021. I think it's pretty clear. Wanted to share that with you guys. Be careful of who you listen to. If you listen to somebody from the depository, they may either unwittingly, because of ignorance, or intentionally mislead you with information that I think when you look at what's going on in the actual market, you can see may not be the true story. So be careful who you listen to. Potential authoritative figures can tell you there's enough gold and silver. That doesn't mean it's true. Maybe they're not looking at all the data and making logical conclusions, or maybe they have an intent to deceive. I don't know what is the case and what happened to me and what that person told me, but I think it's blatantly obvious that person does not have the right story, neither silver or gold, in terms of what's physically available. And again, I continue to question the COMEX numbers for that reason. I think I've shown you a ton of new data on that today. And I think we made a good bull case for silver as well, from what we talked about last week in the videos to what we've talked about today with the increased investment demand. I think it's going to be really good for silver going into 2021. So get your physical silver, maybe go look at your your silver miners. And those are a couple of good options for you to play the silver market for 2021. Till next time, this is Robert Keens with goldsilverpros.com.
Here at Glint, we're making money fairer. How? By using gold. Glint lets you store, exchange, send, and spend multiple currencies, including gold, through a simple iPhone or Android app. Register for your Glint account today by downloading the app from your favorite app store.